You buy a house, you find a tenant. Every month, rent shows up in your account. The mortgage gets paid automatically, and whatever's left over is yours. That's the fantasy, and it's the reason so many people say the same thing when they imagine getting rich slowly. I should just buy a rental property. It sounds almost boring in its simplicity. A house is a real physical thing. Tenants need somewhere to live, and the math seems to just work itself out in the background. It doesn't work itself out in the background. And the way it actually works reveals something most people never think about. Renting out a house isn't really a housing business at all. It's a debt business that happens to use a house as collateral. Understanding that one distinction changes almost everything about how landlords actually make or lose money. And it explains why some of them get quietly wealthy, while others, holding what looks like the exact same kind of property, get wiped out. Let's start with the version everyone believes, because it isn't wrong exactly. It's just incomplete in a way that hides the real risk. The rent covers the mortgage illusion. Here's the pitch you've probably heard. Rent from the tenant covers the mortgage payment, property taxes, and insurance, with a little left over as profit. Meanwhile, the house itself is quietly gaining value every year. So you're getting paid twice, once in monthly cash flow, once in long-term appreciation. It's the closest thing to a guaranteed win that real estate influencers ever promise. The problem is that this version treats rent minus mortgage as if it were the whole business. It isn't. That number is closer to gross revenue than it is to profit, and the gap between the two is where almost every landlord's financial education actually happens, usually the hard way. To see why, you have to separate two things that get blended together constantly: cash flow and cash-on-cash return. Cash flow is simply what's left after rent minus expenses. Cash-on-cash return asks a sharper question. How much of your own money did you actually put in? And what percentage of that are you getting back each year? A property that cash flows $200 a month sounds fine until you realize you put $60,000 of your own cash into the down payment and closing costs to get there. That $200 a month is $2,400 a year, a 4% return on your $60,000 before a single repair bill shows up. Compare that to just leaving the money in an index fund, and the guaranteed rental income starts to look a lot less impressive. This is the first quiet correction the topic forces on you. The size of the rent check tells you almost nothing about whether the investment is actually good. A property can be fully occupied, generating steady rent, and still be a mediocre or even losing investment once you measure it against what you put in and what it costs to maintain. Why the tenant isn't really the customer. Here's where the picture gets stranger. In a typical retail business, the person paying you is the person you're serving, and their satisfaction determines whether you survive. In the modern housing business, especially once you scale beyond 1 or 2 properties, the tenant is important, but they're often not the primary customer the business is actually built around. Consider how most serious real estate investors actually get their return. It rarely comes from rental income alone. It comes from a combination of appreciation, the property's value going up, amortization, a tenant's rent effectively paying down your loan for you, building equity you didn't earn through cash, and, critically, leverage. Leverage means using borrowed money to control an asset larger than the cash you put in. If you put down 20% and the property appreciates 5% in a year, you didn't earn a 5% return. You earned roughly 25% because that 5% gain applied to the entire value of the house, not just your 20% slice. This is why professional landlords talk about their properties less like apartments and more like financial instruments. The rent is what services the debt. The debt is what creates the leverage. The leverage is what creates the real return. The tenant, in this framing, functions less like a customer and more like the engine that keeps the loan payments flowing so the leverage can keep compounding quietly in the background. It's an uncomfortable way to describe housing, but it's the honest mechanical description of how the returns are actually generated. That single reframing, rent services debt, debt creates leverage, leverage creates the real return, is the hidden engine running underneath almost every claim you'll hear about real estate being the best investment. It's also exactly why the business becomes so fragile when any one part of that chain breaks. The metric that quietly runs the whole industry? Cap rate. If you spend any time around real estate investors, you'll eventually hear them describe a building not by its rent, but by its cap rate, short for capitalization rate. It sounds technical, but the concept is simple. Take the property's annual income after operating expenses, but before the mortgage, and divide it by the purchase price. A property earning $50,000 a year in net income, bought for $1 million, has a 5% cap rate. Why does this number matter so much? Because it's the language investors use to compare a housing business to every other place they could put their money. A 5% cap rate is a way of saying this asset, unlevered, behaves like a 5% yielding investment. When cap rates are low, meaning prices are high relative to income, it usually means investors are betting heavily on future appreciation because the current income alone doesn't justify the price. When cap rates rise, it usually means either rents are strong relative to price or prices have fallen because the market has gotten nervous. This is where a widely repeated shortcut comes in, the 1% rule. It says a rental property should ideally bring in monthly rent equal to about 1% of its purchase price. A $200,000 house should rent for roughly $2,000 a month. It's not a law of economics. It's a rough filter smaller investors use to avoid properties that are priced for appreciation rather than income. In many expensive coastal markets, almost nothing meets that bar anymore, which tells you something important on its own. In those markets, the housing business has quietly stopped being about rental income and become almost entirely a bet on the price of the asset going up. That's a meaningful split because it means two landlords owning what look like identical types of property might actually be running two completely different businesses, one collecting real income, the other essentially speculating on appreciation while renting out the asset to cover the carrying costs in the meantime. The costs nobody prices in until it's too late. So far, the picture has costs like the mortgage, taxes, and insurance, the expenses that show up predictably every month. The costs that actually break new landlords are the ones that don't show up predictably at all. Start with vacancy. Even in a healthy market, a rental doesn't stay occupied every single day of every year. Turnover between tenants typically eats somewhere around 1 to 2 months of rent annually, once you account for the time it takes to clean, repair, list, and release a unit. That's not a disaster on its own, but it's real income that a new landlord's spreadsheet often assumes away entirely because the spreadsheet was built assuming 12 months of paid rent every year, forever. Then there's deferred maintenance, which is the quiet killer of the industry. A roof doesn't fail gradually and give you a warning 6 months out. A water heater doesn't email you before it bursts. These are lump sum, no-notice expenses. And the standard advice, set aside roughly 1% of the property's value every year for capital repairs, is exactly the kind of rule that sounds reasonable and gets ignored by almost everyone in the first few years because the cash flow looks fine without it. It only stops looking fine the year the roof actually needs replacing. And then there's property management. Landlords who don't want to personally fix toilets and chase down late rent typically pay a management company somewhere around 8% to 10% of collected rent, plus additional fees for placing new tenants. That's a real, recurring cost that quietly shrinks the passive income landlords were promised. And it's one of the reasons the actual all-in return on a rental property is often dramatically lower than the simple rent minus mortgage math implies. Put these together, vacancy, deferred maintenance, management fees, and you get the uncomfortable truth behind the fantasy. A rental property that looks profitable on the surface can be barely breaking even or quietly losing money once every real cost is counted. A fully rented building, month after month, can still be an underperforming or failing investment. Occupancy tells you the building is desirable. It doesn't tell you the business is healthy. The chain reaction that turns one bad month into a forced sale. This is where the smaller pieces we've already introduced start to connect into something bigger, because none of these problems tend to stay isolated. It usually starts small. A furnace breaks in a unit that was already running a thin margin. The landlord, low on reserves because they never actually set aside that 1% maintenance fund, delays the repair by a few weeks to spread out the cost. The tenant, cold and frustrated, either leaves at the end of the lease or, in a worse case, stops paying rent in protest while staying in the unit. which, depending on local law, can turn into a lengthy and expensive eviction process rather than a quick vacancy. Either way, the unit goes empty or non-paying at the exact moment the mortgage payment is still due in full. One missed or reduced rent check might be absorbable. But if the landlord owns just one or two properties, which describes the overwhelming majority of landlords, not the institutional ones we'll get to shortly, there's often no cushion from other units to cover the gap. The mortgage payment gets made late or missed. That damages the ability to refinance on good terms later, especially if interest rates have moved against the landlord in the meantime. If the landlord needs to refinance to cover a repair or to buy time, they may find the terms have quietly gotten worse. A lender is far less generous to a borrower with a recent missed payment and a property with deferred maintenance. Now, the property is a genuine financial liability rather than an income source, and the landlord faces a choice that's much worse than the one they started with: sell at a loss to escape the debt or hold on while the situation compounds. This is the domino effect that the fantasy version of landlording never accounts for. One unglamorous mechanical failure, combined with thin reserves, can travel all the way to a forced sale. It's not usually one dramatic event that ends a small landlord's business. It's a sequence, and every step in that sequence was seeded by a decision made months or years earlier. Skipping the reserve fund, underestimating vacancy, buying at a cap rate too thin to survive a bad quarter. The case that shows what happens when this business gets industrialized. To see how far this can be taken and what it looks like when the debt business wearing a house costume description gets applied at massive scale, it helps to look at what happened after the 2008 housing crash. Between roughly 2008 and 2012, home prices in much of the United States had collapsed, and lenders were sitting on an enormous number of foreclosed single-family homes they didn't want and couldn't easily sell. At the same time, large institutional investors, most prominently the private equity firm Blackstone, recognized something the fantasy version landlord narrative had never anticipated. Buying thousands of individual houses at scale using cheap post-crisis financing could function almost like buying a single enormous apartment complex, just spread across a metro area instead of one building. Blackstone launched a business, Invitation Homes, that began buying tens of thousands of single-family houses at depressed prices, largely with debt, betting that both rents and home values would recover. The beginning looked almost too good to be true from an investor standpoint. Homes were cheap, financing was inexpensive, and the demand for rental housing was rising as many former owners, some who had lost homes to foreclosure themselves, needed somewhere to live. Invitation Homes and similar single-family rental operators scaled quickly, eventually amassing tens of thousands of homes and going public with an IPO in 2017, later merging with a competitor, Starwood Waypoint, to become one of the largest single-family landlords in the country. The peak of the story is the scale itself, a business model that essentially turned owning a rental house, historically a cottage industry run by individuals, into something that traded on the stock market, priced like a bond and analyzed by Wall Street the same way any other yield-generating asset would be. That's the clearest possible demonstration of the earlier point. Rent services debt. Debt creates leverage. Leverage creates the return. Done not but with tens of thousands of them, financed through securitized debt instead of a single mortgage. The complications that followed prove the earlier warning just as clearly. Managing tens of thousands of geographically scattered single-family homes turned out to be operationally far harder than managing an apartment building, where all the units are in one place. Maintenance costs didn't shrink the way costs typically do at scale. Each house still needed its own roof, its own HVAC system, its own individual repairs. Tenant satisfaction and public scrutiny became genuine risks. Institutional single-family landlords have faced criticism and, in some cases, regulatory and legal scrutiny over rent increases, fees, and maintenance responsiveness. And the sector has drawn attention from lawmakers concerned about large investors competing with ordinary families for starter homes. None of that erased the profits these companies generated, but it demonstrated something the small landlord already knows instinctively. Scale doesn't eliminate the fragile parts of the chain: vacancy, maintenance, tenant relationships. It just moves them from a kitchen table spreadsheet to a quarterly earnings call. What the case proves at either scale is the same lesson. The profits came primarily from buying distressed, undervalued debt-backed assets and riding a recovery in both rents and home values, not from some newly discovered efficiency in the business of housing people. It was the same leveraged bet the individual landlord makes, just executed with institutional financing terms and enough scale to survive the bad months that sink a smaller operator. How the industry adapted to its own fragility. The response to all of this fragility across the industry has been a steady move toward professionalization, because the amateur version of the business, run on instinct and a single mortgage, kept exposing its own weak points. Property management software now automates rent collection, maintenance requests, and tenant screening, reducing, though never eliminating, the human error that used to compound small problems into big ones. Institutional landlords use portfolio-level reserves, meaning a broken furnace in one house is absorbed by rental income from thousands of others, rather than threatening a single owner's ability to pay their mortgage. Lenders have become more sophisticated at pricing risk into rental property mortgages specifically, often requiring larger reserves and higher rates than an owner-occupied loan would carry, precisely because they've learned how often the smaller, thinner margin version of this business fails. Even the smaller, independent landlord segment has adapted, if slower and less visibly. The rise of umbrella insurance, LLC structures to separate personal and property liability, and rent guarantee insurance products all represent attempts to patch the same underlying vulnerability. An individual owning one or two properties has almost no room for error, and the industry has slowly built financial products specifically to sell that missing cushion back to them for a price. Best case, realistic case, and the version nobody advertises. So what does this actually mean for the person who buys a rental house? In the best case, a landlord buys at a reasonable cap rate in a market with genuine rental demand, keeps a real maintenance reserve, gets a good tenant who stays for years, and rides a period of both rising rents and rising home values. Over a decade or more, the combination of appreciation, amortization, and modest cash flow can meaningfully outperform simply investing the same down payment elsewhere. This is the scenario the fantasy is actually describing, and it does happen. In the realistic, ordinary case, the landlord earns a return that's decent but far more modest than advertised, once vacancy, maintenance, and management costs are honestly subtracted. Often closer to what a diversified stock portfolio would have returned, with dramatically more personal time, stress, and concentrated risk involved, since almost all their capital sits in one asset in one location. In the realistic negative case, a landlord buys near the top of a local market, underestimates the reserve they need, hits a run of bad luck, a difficult tenant, an expensive repair, a vacancy at the wrong time, and ends up in the chain reaction described earlier. Thin cash flow, missed payments, a forced sale that erases years of the equity they thought they were building through amortization. And in the true failure scenario, the property is foreclosed on or sold at a loss large enough to wipe out the original down payment entirely. The outcome that never appears in the pitch, but that shows up often enough in the data on small-scale real estate investors to be a real and predictable part of the distribution of outcomes, not a freak occurrence. The honest answer to the central question, is owning a rental property actually the passive, reliable wealth builder it's sold as? Is that it can be, but only for the landlord who understands from day one that they are not primarily in the business of housing people. They are in the business of managing debt, using a house as the collateral and a tenant's rent as the mechanism that services it. The ones who succeed tend to be the ones who priced in the vacancy, funded the reserve, and treated the leverage with respect. The ones who fail tend to be the ones who saw the rent check, saw the mortgage payment, subtracted one from the other, and mistook that thin, fragile difference for a business. That's really what this industry is underneath the appealing surface. Not a story about houses at all, but a story about who can survive holding debt long enough for time, appreciation, and somebody else's monthly rent check to do the quiet work of building wealth, and who runs out of cushion before that process ever gets the chance to finish.